통화 스와프가 되지 않는 상태에서 3,500억 달러를 인출해서 지금 미국이 요구하는 방식으로 전액 현금으로 송금 투자해야 되는 상황이라면 대한민국은 다시 IMF를 맞게 됩니다.
First came the headlines about hundreds of South Korean workers detained at a Hyundai-LG battery plant in Georgia. Immigrants arrested, photos in shackles. Then came a bigger warning. From Seoul itself, President Lee Jae-myung has issued a red alert, warning that South Korea could face a financial crisis not seen since 1997 if it accepts the U.S.'s current investment demands without proper safeguards, he said in an interview with Reuters. So what's this deal? Well, back in July, Seoul and Washington shook hands on a framework deal. South Korea would channel $350 billion in investment into the U.S., and in return, the U.S. would roll back some of its tariffs on Korean goods. But the deal isn't signed. Why? Because the U.S. wants control over where and how that money is spent, requiring investments that Seoul says are risky and one-sided. Here's where it gets dicey. Lee says without a currency swap line, investing $350 billion in cash in the U.S. could strain South Korea's economy. Why? Well, a currency swap is like a financial safety net between two central banks. Here, the Bank of Korea and the U.S. Federal Reserve. It allows Seoul to instantly exchange won for U.S. dollars in times of stress, keeping foreign reserves stable and protecting the won's value. Without that swap line, withdrawing and investing $350 billion abroad could drain Korea's dollar reserves, just like what triggered the 1997 Asian financial crisis. The won isn't the yen. South Korea's reserves aren't Japan's. Tokyo struck its own deal with the U.S. $550 billion investment, favorable terms, swap lines, strong reserves. Korea's Lee says can't replicate all that. Seoul is being asked to match Japan's deal, but under much tougher economic constraints. Add to this the recent storm, the Georgia raid. Over 300 South Korean workers were detained on immigration grounds. That has added fear among Korean companies. If workers are treated this harshly, they say it raises questions about the safety of sending talent to the U.S. Lee has made it clear he's willing to finalize a deal, but only if it's rational and fair. Investments must be commercially viable. He is pushing for protections, especially the currency swap with the U.S., so that moves don't destabilize the won or drain reserves. What does this mean for everyday Koreans? Inflation, borrowing costs, export competitiveness, all could take a hit. Industries that rely on exports, especially cars, electronics, batteries, could be squeezed if tariffs stay high and investment obligations remain opaque. But this isn't just risk, it's leverage. South Korea knows its strengths: technology exports, batteries, chips, vehicles. By pushing back, Seoul is trying to negotiate from a position of strength. If Seoul walks away, tariffs could stay high. U.S.-Korea trade could suffer. But if Seoul caves, it risks exposing its economy to instability, foreign currency risk, and potential capital flight. As Lee heads to New York for the UN General Assembly, he'll carry not just Korea's story, but a cautionary tale for every nation being asked to play big financial cards with little guarantee of protection.